Hello, welcome to Chapter 1. This is your professor, Nathan Aragon, making you a short video to help explain a little bit what the notes tell you. Now, this is all about the intro to accounting itself. So, being said right there, first thing is our definition and purpose of accounting. Now, accounting is an awesome career to get into. I will tell you this because it is very important for any business. It has been known as the language of business itself. So prepare in this class to learn a lot of things that will be like learning a foreign language. But I'm here for you and we'll go and get this going. So biggest thing that accounting helps us with is decision making. We have to make decisions based on financial statements, how well the business is doing, and we're going to be getting a little bit into this using pretty much the financial side, not the managerial side. It's mostly also dealing with capital allocation. That basically means that we take what looks like the money, journal entries, financial statements, and all that, and see where the money's going. We're allocating the money to the right accounts to make the best of the situations. And society will take that and go, hey, your business is doing great. Or, no, your business sucks. It's not doing well. It's bad. I am not investing in that. And as accountants, we want to kind of curb it to the good and for managerial, but we want to always do it in an ethically way. Now, basically for decision makers that we have, as you can see, we have both financial accounting right here, and this is to external users. External users is anyone really outside of the company, so that includes our investors who are taking our financial statements and seeing if they want to give us money. Same thing with lenders. Customers will look at us and they will go, should I shop there? They look like they're going bad. Or we're just going to wait till clearance. Yeah, clearance is awesome. They're going out of business. Clearance is good. Yeah. Or the federal government. Federal government, we got two big ones that will look into our financial statements. One is, of course, the SEC, which if it's a publicly traded company, the SEC will look at a lot. If it's basically the other one is the IRS. IRS will definitely look at anyone because they want taxes, and everybody pays taxes until we are gone, and then we still pay taxes. It will never go away. Sorry. I'm sorry on that. The other type of accounting that you will see is managerial accounting. We do not focus on this part in this class. This is the next class in 2302 that you will see. So it's not too bad. But once you get into that one, which depends on how your schedule is, I would suggest probably take it next time, and next semester, next time we offer it, just so you can get it out of the way. But that will focus on the internal, or mostly it's company managers, CEOs, and items like that. But our main purpose, as you can see I've already mentioned, is creating financial statements. We are going to get into how financial statements are made, how people look at it, sort of, and basically journal entries, journal entries, journal entries. So, with financial statements, they have to follow certain guidelines. In most publicly traded companies, this is known as the General Accepted Accounting Principles, or GAAP. We follow these rules to a T, and if you don't follow these and you're a public traded company, you could face massive amounts of penalties. And basically, GAAP is determined by the Financial Accounting Standards Board, or FASB. So if you ever hear the acronyms GAAP or FASB, this is what they're talking about. They're talking about either the general accepted accounting principles, which we must follow when we prepare financial statements, and they're talking about the main board. Now, FASB tends to be, they're the ones that actually make GAAP. They govern it, they make the rules, they're going to figure it out. If you're travel outside of this country, outside the US, it's a different board. They have the International Accounting Standards Board, and they have their International Financial Reporting Standards, IFRS. Now, it hasn't been done yet, but there is talks that these two, GAAP and IFRS, are going to combine into one item. So it's always good if you want to take a little time and research some of the IFRS and GAAP rules, and just be prepared if you're going down this track. It's always good to know how these work and basically some of the rules. We're not going to get too heavily into the actual rules of IFRS. GAAP, we'll get into a few, but just know the basics of what they are. So, what is GAAP? Well, GAAP has to follow three principles. One, is it relevant information and affects the decisions of users? Is it relevant to our cause? Is it relevant to our business? Two, is it reliable? Information is trusted by users. So, are we honest? Are we showing the truth? Can they actually take that and go, yes, this is trustworthy? The third one, comparable information and helpful in contrasting organizations. Are we following the industry? Are we just showing numbers just to show numbers to make us look good? Or are we actually making it where if an investor looks at our financial statements, can they compare it across the industry and actually work it? This is the big issue. These are big, heavy with ethics. And we're going to get into ethics in a little bit, but focus on these and kind of see how ethically good or bad we can actually adjust these and why the laws are here for us to actually follow. Because we really want to watch out and follow these laws because we really want the investors. We want the money. And you don't want to go to jail. I don't want to see anybody in jail. So right here, the pyramid that shows right here is actually the conceptual framework of how they try and coverage and enhance the items. Mostly, take a look. We want to first recognize and measure. Basically, will the criteria meet for what we're doing? What element? Elements are basically items in the financial statements that can contain, is it going to be related to cash, accounts payable, owner's equity. Again, all these terms we'll get into in the few chapters that we're going to hit. Quantitative, basically, is it going to follow the three rules of GAAP? Is it going to be reliable, relevant, and comparable? And then objectives, we must provide information that's useful to who we were targeting. So if this GAAP rule is towards customers, it probably is going to have something dealing with how the sale goes, how to report this, and it will basically get a little bit better. Again, we're not going to go heavily depth. This is pretty much what you're getting is right here. This is it. I'll be honest, we're not going to go any more in chapters. Chapter 1 is it, because chapter 1 is just the basics. We want to see if you can recognize these, what they are. Okay. Now, going next to the next exhibit that you will see, principles and assumptions of accounting. These are keys. I'm definitely going to mention these over and over again. because these are like the foundations. Okay, so just like a building, we have foundations, we have basically what builds up the building, every little level. These are our big levels. And let's see. Ooh, zoom. So the biggest things, we got 4 major accounting principles. Again, there's always more, but these are the 4 we're going to focus on. One is the measurement principle, where accounting information is based on actual cost. Now, actual cost is considered objective, meaning it's basically market cost, but the big key with measurement principles is, can we put a number to it? It has to be measurable. So just like in anything in math, it has to have a number. This is where our big number item is. The next principle is the revenue recognition principle. This is basically where we have to recognize revenue when it is earned. So if I receive cash on January 31st, I must report cash received January 31st. If I did a job, say I did a construction job, but I did not receive cash, but I did something and I've earned the money, I just haven't received it, I still have to report it in the year that it's earned. This is basically, these are the 3 rules in that. So again, we must recognize the revenue when it's earned. Proceeds don't have to be in cash. You can actually barter in this too. So, and it has to be a measure revenue by cash received plus cash value of items received. Now that's mostly when we trade in cars or really the big barter. But the biggest thing here is whenever we earn our item, we must report it on our income statement. Okay. Next one is the expense recognition principle. Basically, it's the same thing as the revenue. We must report expenses as they occurred that generate the revenue reported. So, expenses that are incurred, we must report same year, same fiscal period, and we're going to get into all these when we're doing journal entries in later chapters. The last principle is known as the full disclosure principle, and basically we are required to report the details behind financial statements that may impact a user's decision. Just a couple of years ago we had Hurricane Harvey, and that made a lot of businesses in trouble. So we had to fully disclose, why are we reporting all this loss, what happened, and this will impact users' decision if they want to invest in the company, if they want to help it to grow again. And so we'll have those. A lot of this one, full disclosure principle, is in auditing. So if you're not going into audit, you probably won't have it too much, but even in tax, we do a lot of full disclosure too. We have to tell the IRS, what is this? So always be wary of these 4 principles. Now, principles and assumptions. Principles are ingrained. They're the rules that we have to follow. Assumptions is items that basically what it defines. We assume this is going to happen, but it is just our opinion on the matter. And there's a few things. The biggest one in these is the growing concern assumption, which basically is our opinion when we do an audit. Is the business going to survive? Is it going to continue? Is it going to go, or is it going to go to the wayside? A couple of big companies that we already know, like Toys R Us, they had a big growing concern when they took on the debt that they had. Sears has a growing concern right now. GameStop has a growing concern. In fact, at this time of this recording, they may end up being sold in February of 2019 to another company. We have to look at this and we have to make an assumption based on the numbers. Will the company survive? Next one is the monetary unit assumption. This is basically, we assume that the transactions are going in certain money. We may have to convert currencies, um, like peso to the dollar or the dollar to the pound, depending where we're at and how the business operates. But we automatically assume that all journal entries are in this monetary amount. Next one is business entity assumption, where the business is accounted for separately from other business entities, including its owner. Basically, we assume that this is what the business is. It could be an S Corp, C Corp, LLC, sole proprietor. We don't know. We just assume when we get it, but we usually figure this one out a little bit later on. And then time period, we basically presume that the life of the company can be divided into time periods such as months and years. Basically, we just assume that it can be in years. It's basically figuring out their financial. Though these three, we don't assume too much. It's usually growing concern that ends up happening with basically our seeing if a business is going to go good with the auditing. Next one, we have two constraints. We have to follow these constraints. They actually kind of hold us to a T, as constraints do. Think of a straitjacket here. We can struggle all we want, but we have to follow these to a big old thing, big old T right here. One is materiality. Is it material to the information that is being provided to influence somebody in their reasonableness? Are we showing what we need to show? Now, materiality happens in all cases. Auditing is a big one. They're going to figure out if this account is very material to them. Basically, if I show a business that has $1 million profit, and the only reason it does is because I did not show something that was material, a $500,000 loss or expense, and I actually had $500,000. Could I influence investors to invest in me that they assume that I had $1 million profit? Yeah. So we have to say 500,000 is very influential because that's a big thing. Now, say the same scenario. I had the $1 million net profit, but I didn't record an expense that's 5,000. Would investors really care if I didn't? About that 5,000? No, it's really not material compared to $1 million profit. So it has to be something big, something that can actually really influence you. Biggest company right here is Enron. Enron did this a lot with their financials to get more people to invest before they went bankrupt. So, you always want to make sure, will it influence somebody? Will this really influence? The other one is cost benefit. This is only information with benefits or disclosure greater than their cost needed to be disclosed. That's the definition right there. Basically, will I make more money than what it cost me? This is buying a machine. If I buy a machine and it's going to cost me $1 million, but the machine itself will produce about $2 million worth of product, did it benefit me? And you probably should have said yes. If you take the same scenario, the machine gave me, it cost me $1 million, but I only get $500,000 worth of product from it. Is it good for me? No. So those are the two constraints. We're going to be constantly with that. Cost benefit tends to work more with managerial accounting and doing the reports and stuff to make sure things work, but we still will do that with the financials. And we'll get into a little bit of cost benefits as we go on. So now, the big bad boy. Now, if there's anything that you learn while we start off, is our formula right here. This is the major formula of all accounting. the holy grail formula. Assets equals liabilities plus equity. So if you have your notes open, highlight that, do whatever you need to, memorize that. Now, I know you don't know the terms are right there in the notes, but that formula is the biggest. And of course, algebra sometimes gets used, but if we want to, you can also go assets minus liabilities equals owner's equity. That's something else, but this is the big one. We have to know this. Now, big things. What are these three? Okay, first one, assets. Assets are resources owned by the business. Now, what is owned? Well, first off, do we have ownership of that item? Cash. Do we own that item? Yeah, we own it until we pay something and somebody else takes the ownership. Buildings, vehicles, prepaid insurance policies. All these are assets, and we're going to get into these as we go, but we will introduce these accounts in this chapter. You want to see a little bit on your homework, but we want to make sure that you understand that these are owned by the business. Next one, liabilities. So, liabilities, if assets is anything that we owned, liabilities is anything that you owe to creditors. So this includes credit cards, accounts payable, loans. These are all items that we owe somebody that we have to eventually pay them. So if we have to pay somebody, this is going to most likely fall into liabilities. Once we've paid them, then it becomes a different account, and that's known as an expense. Except for a few liability accounts, which we'll get into as we go. Okay. The last one is equity. Equity is the rights of the owners to the business resources. So this is basically the investors that come in and get basically some stock. So now that you have a percentage of the company, this is where we're going to post anybody's ownership in the company itself. This also has a big account that we go with in retained earnings. Retained earnings is basically any previous earnings of the company, basically what is known as net income, that have not been paid out in the form of a dividend. So we haven't paid the ownerships the little dividend to basically from the income earned. Retained earnings is a big account, and we're going to be talking about it in quite a few chapters. But remember this, that equity has two major accounts right now, common stock and retained earnings. And we're going to get into the formula for retained earnings in just a sec. So right here is a little graphic. I like this graphic. It actually just kind of pops to you. Again, same formula, the accounting equation, but look down here. Here is like a little formula right here. This is basically our equity, contributed capital plus retained earnings, are basically common stock right here. So, break down the retained earnings. You have dividends, you have revenue, and you have expenses. We always add revenue and we subtract out dividends and expenses. Now, revenue and expenses themselves is known as net income if revenue is greater than expenses. Net loss is the other way around. Expenses are greater than revenue. But this is a nice little graphic because I guarantee you're going to be having this breakdown a little bit later on in this course, probably in this chapter. Okay? And boom goes the dynamite. Here we go. So, additional certificate account classifications. These pull from our other ones. Now, assets, liabilities, and equity. This is your balance sheet formula. This is basically balance sheet, which we're going to get into the three major financial statements. The revenue expenses, this is your income statement. So, Revenue. Revenue is any money that is earned by a company. If we sell it, if we provide it, any service we do. So, it does not have to be when cash changes hands though. It's basically generated when service is performed. So, once that service is performed, due to the revenue recognition principle that we spoke up above, you must report it. Okay? So, this is also when goods are transferred, anytime that we've earned anything. Merchandising, which we have a whole chapter about merchandising, is goods that are transferred. So, something very cool there we're going to get into. Next, expenses. These are money or resources used by a business to proceed in earning revenue. Okay, again, we are recording when the expense is incurred. So, most of this will be discovered in Chapter 3, which Chapter 3 is a big chapter. It's going to be a fun chapter. Yay. But we will get into Chapter 3 in a few weeks. But Chapter 3 is going to have a lot of the journal entries that we're going to know and love. Dividends. Dividends is a distribution of earnings to stockholders. It is a cash dividend. Pretty much, we always give out cash. We do not give out property right now. Can they? They can, but it's mostly going to be cash dividends. So, you notice that there is 6 major accounting classifications. So, I would definitely know these because, again, Connect likes to use these classifications. Dang it. On everything. So, the classifications again are assets, liabilities, equity, revenue, expense, and dividends. And all these transactions will fit in somewhere of these 6 classifications. So keep an eye on this. We're going to get into Chapter 2 a little bit more with these 6 classifications. But with Chapter 1, we just want you to get, again, the basics. Okay? And then, of course, I love this graphic right here. Awesome graphic. Because if you don't know how many careers are invested in accounting, here it is. And this is just the tip of the iceberg. I mean, there are so many accountings right here. The cool ones I like is your criminal justice kind, the forensic accounting and litigation support. You have to know accounting for it to be an entrepreneur, how to plan, preparation, estate planning if you're in taxes. Managerial, you have treasurers, CEOs, CFOs, they all have to know. Auditing. I mean, there are so many little items around, so many jobs that require accounting. So if you really want to expand your horizon and go anywhere, accounting is a good thing to know. And I really would mean you can go nearly any field and go, accounting is needed. And believe me, if you're still thinking, this is going to be a lot of math, nah. I'm going to tell you this right away. Add, subtract, multiply, and divide. Boom, you're done. We're good. The only times that it gets a little bit more tricky is when you're in audits and stuff where you're going back. You just have to use algebra to kind of figure out what's going on. Find the missing piece. But besides that, it's really not math driven. It's mostly categorical driven. So, you heard me mention these a little bit before. Here they are. These are the major financial statements. In accounting, or financial accounting, there is 4 major statements. One is the balance sheet itself. This one will list all the assets, liabilities, equity, and it's always on a specific date. Your headings will always be the specific date. You will never really see too much difference. And they tend to be at the end of the month or the end of the year when we actually decide to pull it. But they can be pulled for any other date. This is really known for the specific date because balance sheet goes on forever. It does not stop, it does not close out, it doesn't do anything, it goes on forever. That's why we can only pull it for specific dates. Income statement is a little bit different. The formula is revenue minus expenses will equal net income or net loss, depending on which one is greater. The income statement is prepared for a period of time. This is usually going to be for a month or a year, and it will say for the month ended, for the year ended. You will see that. That will definitely tell you if it's a perpetual or periodical little statement. For these, they do close out, and we'll get into closing entries for the income statement when we get into chapter 3. But basically, the income statement will shut off every year, and it will restart. So, like a light switch, on and off at the end of the year. Okay. The thing is, with retained earnings statement is basically going to be similar to the balance sheet. Retained earnings statement is basically another statement that basically tells us what went into the retained earnings in the equity section of the balance sheet. So this is going to have this kind of formula. Beginning retained earnings plus net income minus any dividends that we gave to the owner will equal out the ending retained earnings. Notice we have it right here. It is actually similar to your bank account. So if you want to look at it that way, the beginning balance, wherever you had in your bank, plus any money that you made, deposits, minus anything you withdraw, so will equal out to ending balance. They basically mimic the same way. It's a good way to actually reference and know what happens in the retained earnings statement. The last statement that we have is known as the statement of cash flows. Now, we're going to get a little bit into this. This one is not too much focused on in this course, but the statement of cash flows is in chapter 12, and we will get into it. We will talk about it a little bit, but we just want you to know basically how it works and how it goes. But this one will be mostly at the end of the semester, end of the class. So this one has operating activities, in which basically how does the business run, investing activities, what did we actually invest in, any assets, basically fixed assets, and financial activities. So did we get any loans or stuff like that. That one, again, we're going to get into at the end, so no worries on that. Focus on the first three. Those are the big three that we're going to hit. And as you can see, here is the order that we actually prepare the statements. Balance sheet is always going to be around, so it will come to us. But the first statement that we like to do is the income statement. Basically, we want to know what the revenue and expenses are, because income statement is going to feed into the retained earnings statement because it produces the net income. Net income is needed for the retained earnings statement. So then we prepare the retained earnings. We find the ending balance of the retained earnings, and then it feeds into the balance sheet. Notice it feeds in. Now, the balance sheet does have accounts that are not part of the other statements, so we can already put them in. But basically, in order to prepare, we're just feeding in that specific information. Net income goes to retained earnings statement. Retained earnings, ending balance goes to balance sheet. Last part, statement of cash inflows, will actually have what happened with cash, and it's going to basically take everything from the balance sheet itself. So here's a few bit of samples just to show you that flow that's going on. We're using a company known as Fast Forward. Again, it sounds like a video retail company, if y'all remember VHSs, but this is actually a consulting firm that we're using. So the first statement that you see here, right here, is known as the income statement. Notice that does have the revenues. They had two forms of revenue, consulting and rental. And then they had their expenses. Notice they only had two expenses also, rent and salaries. Remember, this is just an example. So we add up the revenues, add up the expenses, subtract the two. We end up with 4,440. This is our net income. And then look as it flows right into the retained earnings statement. And again, this company just started, so it did not have any retained earnings starting off. So we add the net income, but they did pay out dividends of 200, so subtract 200. So our ending retained earnings is only 4,200. Take that, move it to over here with retained earnings. Boom, there it is. Now, this one, I know the notes don't go into the cash flow statements, but this is basically showing cash is going to the cash flow. Again, we're going to get into that in chapter 12. Our main focus is these three big ones. So this will show all your assets. So they have cash, supplies, and equipment. They add all those up to total assets right here. They only have one liability of accounts payable, so their total liabilities is 6,200. They had common stocks of 30,000, and then 4,200 came down to retained earnings. So their total equity is 34,200. Now you add your liabilities and equity, and it should be 40,400. Do they match? Yes. We know we did good. Boom. That's how everything's in balance. Notice, I will tell you this throughout this course, you're going to notice how much accounts are simple in the way we label stuff. Notice this is known as the balance sheet. Assets must equal liabilities equity, or be in balance. So if they're not in balance, then we have problems and we must look into it. Again, we're going to get more heavily debt in these financial statements as the course goes around. Okay. The little thing that we got here is you do have to know types of businesses. We're going to focus on a few of these businesses as we go. One is known as the service business, which provides services to customers. So anything that's intangible, you would say. Something that we cannot really feel and touch. So accountants, lawyers, daycare providers, hair salons. Again, you can touch your hair, but are you actually cutting your own hair? No, can you touch that? So anything that provides a service is known as a service business or service industry. Next one is manufacturing businesses. These ones create products and sell them to other businesses or customers. So like right there, General Motors with cars, Dell computers, Boeing, airplanes. I mean, anyone that actually converts raw material to an actual product that actually sold. Manufacturing business is going to be big in 2302, but these are going to have inventory just like the next business, the merchandising business. These are the ones that actually sell the products to businesses or other customers. Good examples again are Walmart, Amazon, Home Depot, and Best Buy. And usually they buy products from manufacturing business to resell. These are resellers, these are wholesalers, but just know the different types. We're going to get into merchandising businesses in chapter, I think 4. Chapter 4 is going to be the big one on that one, and that one's going to be fun. Believe me, it will be fun. And then the last little part, or getting close to the end, is the types of legal structures for businesses. These you don't have to know heavily, but know exactly what they are, how they are. One is the priorityship, is basically owned only by one individual. Now, for purposes of married couples, husband and wife, they are considered in the eyes of the government as one individual, so they can fall under this also. Basically, this is the big chunk of businesses in the US. It's about 70% of all business entities are basically this. They just startup companies that we decide to pick up and we decide to create a hobby, and we decide, hey, this is good. We're going to make it a business. Making YouTube videos is a business. Crafting, like Etsy, can be a business. They don't have to have a lot. They just have to have basically one owner. Okay? They're always going to be easy and inexpensive to organize. Guess what? You only have one person most of the time, maybe two if it's a married couple. Don't have very many employees starting off. You may end up getting some, then it starts getting a little bit more organized, but still relatively easy. It's just you and employees. Resources are limited to those of the owner and used by small businesses. In this world, this economy, we are basically run by small businesses. If we don't have competition with these small businesses, things slow down. So we usually like to see more people become entrepreneurs and try it out. Again, most small businesses, in 5 years, it's either going to fail or succeed. Most do fail in 5 years, but hey, never know. Get into it. You may actually do very well. You may have a great idea. Maybe next Apple or Google. Who knows? So, next one we do have is partnerships. These are owned by 2 or more individuals. Basically, again, you can do a partnership with a married couple. It's not really common anymore. This is basically you got somebody else in that's probably going to be your source of financing, but you gave them a portion of the business. Kind of like watching Shark Tank. So if you watch Shark Tank and they're buying portions of the business, this is the partnership that's going in. Mostly it's also a lot of professional businesses, lawyers, accountants, stuff like that. They tend to be more partnerships. And so, is 10% of the business organizations in the United States, and that 10% is combined with something that you see at the bottom of limited liability companies. So, they do make up some, not a lot. I guess people don't really like to share with each other. But partnerships tend to be around their tax. If you look at the tax one, these are 1065s. So they're cool also. The major one that we have that we're going to kind of focus on more is corporations. These are organized under state or federal statutes as a separate legal taxable entity. They are usually generate the 90% of business revenue. Yay! The only thing is 20% of these business organizations are in the United States. Most of these big corporations are outside the US, so they don't really help provide taxes and other items that US needs. So corporations are huge. They have a lot of money to go out, and they usually give out dividends in stock to them. So mostly anything on the stock exchange is a corporation. And they can basically get large amounts of financing very quick. They're very liquidable. They want to look at that way. And again, some of the examples right here: Apple, Google, Ford, the Ford Motor Company. That's now kind of is the only company that did not receive government funds when the government came out. But it is actually a pretty good little thing going on. So anything big is a corporation. And then for taxable, they're going to be, they've got certain things too. Again, the corporation, we're going to get into later in a later chapter more of the structure itself. So be prepared for that. The last little thing that has grown like fire wildfire is limited liability companies. These combine basically the attributes, the good ones, of a partnership and corporation. They basically protect partners away from losing their assets, their personal stuff. That's all with the company. You're going to see this most likely used now. So we're going to get into that a little bit later on. But you're going to mostly, anytime you see LLC, that's what it stands for, Limited Liability Company. You may see PLLC. Those are only for professionals. So again, lawyers, stuff like that, accountants, anybody that's a big professional. So the next part in this chapter, yay. Again, this is chapter 1, so it's going to have a lot to it. Is the role of ethics in accounting. We have to be very ethical. Money is closer to our hearts than most items. So they really want you to be prepared and watch out. We get into fraud. You're going to see fraud mentioned a few more times as this course goes. But you do need to know the 3 sides of the fraud triangle. And that's basically rationalizing. As humans, we rationalize every decision we make. We're going to justify the actions when they happen. The next is financial pressure. So, if we have unpaid bills, we got Greedo coming after us for a loan that we did from a loan shark. These are things that will basically give us pressure to actually commit the crime or commit fraud. Next thing is basically the opportunity. Is there a way that we can actually do the crime without getting caught? Very low perceived risk. This usually happens when you have the accountant and they do not only write the checks, but they cash the deposits, they take in the money, they basically do more items than they should have, and you don't have a proper separation of duties, which happens a lot with small businesses. And there's more of a growth of basically fraud going on. And then there's certain aspects in the accounting cycle that fraud can actually hit a little bit harder, which we'll get into when those things come. I will tell you this, a great show to watch, if you can, is a show called American Greed. And this goes into fraud a lot. And you also see which basically career tends to be the one that gets focused on a lot. So yes, accounts, we have a lot of pressure, we have the opportunity a lot, but it is best to not commit fraud. I don't want to read a newspaper and see any of my students online or in person to actually be put in jail for fraud. If you do it, I am definitely going to visit you and just say, why? Why? Don't do it, please. So, watch out on this. Know the factors, because, of course, we can always throw this as a multiple choice question on a quiz or exam. It's easy. There's 3. If I give you 4 multiple choice, there's probably 1 that's not. So, watch out. The next thing that really came from fraud is known as the Sarbanes-Oxley Act, and its acronym is SOX. So I'm not talking about the White Sox, I'm not talking about the Red Sox. This is actually the government SOX. So when you hear SOX, don't go to sports if you're in the accounting world. It's basically talking about this one, and this one was basically made after the biggest company known as Enron basically went belly under due to all the fraud that was in it and took down one of the big accounting firms in Arthur Andersen because they were fudging numbers, they were not doing everything that they should. So government came in with the SOX Act and told us this is how you're supposed to do audits. This is how you're supposed to do financial statements. So we got told by the government how to do our job because apparently we couldn't do it. So this law is right there for that. And if you ever get into a rules and regulations class, you will see SOX. It is going to be there like the Dodd-Frank Act. It will show you there, and you're going to go, oh, here it is. This is why it's here. Ah. But in the graphic right below here, this big old graphic with the ball and chain guy that's going to jail right there, you'll see some of the big companies that have been hit with accounting abuses are basically fraud. Enron right there again, and it'll actually tell you inflated income, hid debt, bribed officials. They were the top of doing what they can to try and show that they made profit when they didn't. WorldCom is another big one. This one's actually was in Houston also, and this is they understated expenses and inflated income and hid debt. There's Fannie Mae. Some of y'all may know that. AOL, Time Warner, Xerox. You have Tyco. And if you don't know Tyco, that's Fisher Price before it got bought by Tyco. Basically, they changed their name because they committed so much fraud. But again, hid debt, CEO itself, evaded taxes. Halliburton, who is a big oil and gas company here. Quest Communications, big communications company here, big with routers. Notice that the big thing that they tend to all do was inflate revenues and income. They showed more profits than they actually had. And this was one that broke our constraint of materiality because it influenced investors to invest in these companies when it was actually not true. Shouldn't have done it, and cost people lots of money and pensions and all that jazz, which sucked. So right here, this you're going to see these in the end of most chapters, and these are ratios that we as accountants use to analyze. The first one is basically our return on assets. Did we make money on the asset? Is it going to make us money? Are we doing well? This is basically how well a company can utilize those assets to make money. So the basic formula right here is return on assets equals net income divided average total assets. Average total assets is a little bit easier to make. It's basically going to be your beginning total assets minus your ending total assets divided by 2. And there you go. There's your average. Yay, math. So basically we use this. The more profit that we show, basically the more that it's getting close to 1, the better off that we are. But more or less that comes later than 1, getting close to 0, which of course says that we're not doing so well. So we have to watch out for those. So we'll keep an eye on that. Now, of course, we'll have a few items down here. I would say pause this video right now. Pause it, and or just wait till right now. Pause it so that you can actually fill in these first, see what you get, and then I'm going to reveal the answers. So it's up to you. But we're going to have these. These are just trying to help you out a little bit. But big thing, this is a Word document. So fill it out. Trying to see what you got. First thing, of course, is our formulas. So assets equal liabilities plus equity. Yay. Next is revenue minus expenses will equal your net income. Last little part is, again, net income. So, beginning retained earnings plus net income minus dividends equals ending retained earnings. So keep an eye out. Again, net income is revenue minus expenses. So if you put revenue minus expenses here and then look at this video, you're still perfectly fine. Okay? So determine if each of the following business is an example of manufacturing, service, or merchandise business. First off, accounting preparation tax return. What is it? It is known as a service. Grocery stores, they will be known as a merchandise business, and clothing producers will be known as manufacturing. Awesome sauce right there, right? And which of the following financial statements is associated with each of the descriptions below? The one that deals with operating, investing, and financing, that will always be our cash flows. Assets, liabilities, and stockholders, that is our balance sheet right there. Revenue and expenses is, of course, our income statement. And net income, dividends, and beginning retained earnings is going to be our retained earnings statement. And again, there they all are. Boom. Boom. And red. There we go. Alright. So, you're not going to usually see multiple choice or fill in the blank at the end of each chapter. They're good. Mostly what you're going to see is practice problems. So we're going to add in these practice problems. They're going to kind of look what you're going to see probably with Connect. Not totally, since Connect is its own program, but we're going to basically show what Chapter 1 wants you to do. Okay, so this practice problem wants you to basically know what kind of equity is going on. So we're going to basically say, is it going to be an asset, is it going to be a liability, or is it going to be an equity? Notice down here, you see cash, AR, this is accounts receivable, equipment and supplies, then we have accounts payable, common stock, and retained earnings. So, Chance Taylor, he starts to form a consulting business named Fast Forward. Taylor personally invests $30,000 into the business bank account for Fast Forward. Since he personally invested this amount, anytime we invest, anytime the first transaction that happens, right now this is known as common stock. So for us, we know 30,000 went in common stock. Cash went up 30,000. Notice again with this, they are both positive. Reason why? Cash went up. Business got ownership of cash. So cash has to be positive. Common stock. We owe our owner $30,000. So since we owe them, of course, that has to be positive also. Again, look what we're looking at up here. They have to equal. So with these problems, if you see it in Connect, you want it to basically equal out. So if you get one side, it's going to have the same number on the other. They just have to be both positive. So one cannot be negative and the other positive. Does not compute. Okay. Next one, we have Fast Forward uses $2,500 of its cash to purchase supplies. So here, we're going to look. We see that it says supplies. So that means we find supplies, and it's going to raise by $2,500. So since we use some of our cash, notice that since this is a Word document, you may want to highlight accounts, money, whatever you see. So this actually means we use some of this cash to buy these supplies. We did not use no payables, stock, or earnings. So we must there it is. Didn't want to show up where it was supposed to. But you basically have to put a minus sign right here. Okay? Because cash is going down and supplies is going up. So supplies took some of this cash and now it's a positive account. Again, we're just trying to get you to where you can see how these transactions work. So, right here, number 3, they spend $2,600 to acquire equipment. So, again, they spent money. So, again, cash goes down, supplies and equipment goes up. Right now, we don't have these two accounts separated. They're the same one. So, again, negative 2,600, positive 2,600. Anytime that we put spends, that's usually what cash. And again, there's equipment. Alright. So, number 4 is going to bring something new. This one says they purchased additional supplies. So again, we see supplies. We know it's going to affect this one. And it's going to be for 7,100. And it's going to be on account. So since it's on account, it's going to deal with accounts payable. Anytime it says on account, for our first little divvy into this, it's going to either deal with accounts payable or accounts receivable. Accounts payable is basically for bills, anybody that we owe. Accounts receivable is for our customers, okay, clients, any one of those. So since we did purchase supplies, we know the 7,100 is there. And then since it's on account, it will be our accounts payable. Now, as we go through, again, we're going to look at certain things. Here, we provide a consulting service, and we collected 4,200. Since we have collected the money, we have already earned this because we provided the consulting service. So, since we provided a consulting service, this is revenue. Notice that revenue is not on here, but it is part of the retained earnings formula. So, highlight, there we go, 4,200. Next, where does this fall into? Well, since we provided and collected money, we collected cash. There we go. Okay. 6, we have paid. So we paid $1,000 in rent for office facilities. So when we pay, we know we're using cash. So we won't lose the 1,000. And since rent is usually an expense, so that's usually an expense, we will put this again with retained earnings. Notice, since it's crossing over the equal sign, it's going to be the same number. So right now, we can say we have a net income of 3,200. Cool stuff, huh? Next, we pay 700 to our only employee. So again, we're paying, and this is again an expense. This is known as salaries expense. And again, watch out on my spelling. Sometimes my spelling is bad, and apparently it is not spell checking. So, but basically, other term is wages expense, but it is an expense when we pay our employee. So again, we're paying cash, and again, since it's an expense, boom, all red. Number 8 says we have completed the job and we have billed the client for $1,900. Now, we have billed the client, so we do know we have revenue. We've performed the job and we did it. Problem is, we've only billed the client, so we haven't yet collected the money. So this is known as accounts receivable. When we bill someone yet haven't received the money. As you see with number 9, now we have received the money. So with this is basically taking out the money from the accounts receivable since it came from a client. And again, has a big old keyword of on account. And since it's cash that came in, it's just going to affect one side. Again, notice that how it's affecting either one side or two sides. Mostly, if it's dealing with cash, and it's going to deal either with one side or two sides. If you notice that mostly anytime that it's happened, we've only affected liabilities once. We don't usually affect liabilities twice on their side. So we'll usually have an asset with it. So just be wary of these scenarios. Okay. Number 10, we have paid $9,000 on account, or $900, sorry. So again, we've paid out cash. We paid it on account, so we probably paid a little bit of these supplies. So again, minus 900. Watch out for the minus and positives. They mean totally different things. In chapter 2, we really get into those. Okay. And then the last bit, we paid $200 to our owner. So again, this is a dividend. So here, paid out cash, negative 200. Since it is a dividend, it comes over here to retained earnings, and boom. Last little part, fill in the blanks, make your totals. So here's our totals right here of all the accounts, and of course, if we added them all up, they should equal, boom, we're done. So that is it of chapter 1. Yay. So thank you for heading on with me. If you had a pause, stop, go back, that's always good with these videos. But we'll see you for chapter 2.